Of all the issues facing many Americans these days, especially those approaching retirement age, the management of their money is of paramount concern. Life expectancy rates have increased to the point where one or both spouses in a retired couple can expect to live more than 20 years after retiring. As a result, their investments will need to grow in order to generate income to meet living expenses while keeping up with inflation. Some people try to handle their investments on their own, while many, if not most, turn to professional financial advisors for help.
Individual investors can improve their investment results if they're willing to devote a few minutes each month to identifying which areas of the market are performing best, and then moving their portfolio to emphasize those areas that are performing most strongly. For example, when large company stocks are best, an investor might move more of his assets into that area of the U.S. market.
Although there is no single optimal investment portfolio that is right for everyone, there are two key elements needed for any portfolio to provide the best investment performance: diversification and investment oversight.
Now, by diversification, I mean placing your holdings in different areas of the market where the risks have occurred at different times in the past. That way, if a bad event occurs in the market, it doesn't hit your whole portfolio at once. The fundamental elements of a well-diversified portfolio include four types of stocks: small cap value stocks, large U.S. company stocks, real estate investment trusts or REITs, and international stocks. The portfolio should also include an allocation to bonds.
People have varying levels of risk tolerance, and since there is an element of risk in all investments, it is important to select a portfolio mix that you are comfortable with. Whether you manage your own portfolio or have a professional financial advisor do so for you, your investments should be watched with two goals in mind: containing market risk without sacrificing potential returns, and positioning your investments to take best advantage of prevailing market trends.
One of the most effective ways for individuals to get the best performance out of their investments is to use exchange-traded funds, or ETFs. The big difference between ETFs and regular mutual funds is that investors buy ETFs the same way they buy shares of an individual stock, on a stock exchange, perhaps using a discount broker. Whereas investors buy and sell their shares of mutual funds by dealing directly with a fund company. Here's an example of an ETF portfolio that contains all the essential elements of a well-rounded investment program designed for long-term growth. 25% in SPY, the ETF that tracks the S&P 500, which represents large U.S. company stocks. 15% in IJS, an ETF which represents small U.S. company value stocks. 15% in ICF, an ETF which represents real estate investment trusts. 10% in EFA, an ETF which represents developed country foreign stocks. And 10% in EEM, an ETF which represents stocks from developing countries. In addition, the portfolio should have 25% in AGG, an ETF which represents investment-grade U.S. bonds.
Exchange-traded funds, ETFs, are hot items in the investment industry and one of the fastest-growing investments in the United States.
Although they represent only 3% of the value of stocks traded in the U.S., there are more than 400 ETFs and more arriving all the time. Why? Because a number of investment objectives can be more effectively met with ETFs than with the majority of available mutual funds.
In his new book, Investing with Exchange-Traded Funds Made Easy, published by Prentice Hall, Dr. Marvin Appel explains the advantages of exchange-traded funds over most other mutual funds.
The main advantage of ETFs over most other mutual funds is that ETFs cost you less to own, because ETFs don't have to bear the expense of hiring a fund manager. The result of these lower expenses has been better returns to the investor.
The first decision you need to make is whether you want to put your investments on autopilot, setting up a portfolio to meet your needs and temperament, and then leaving it alone, or whether you want to take a more active role in adjusting your investments to meet challenging market conditions. If you prefer a less active approach, Dr. Appel's book suggests a one-decision portfolio that has historically generated returns with significantly less risk than the stock market. Investors who want to be more involved can refer to Investing with Exchange-Traded Funds Made Easy or the investment newsletter Systems and Forecasts, which is in its 34th year of publication.
One of the ways to learn how to make the best use of ETFs or of carefully selected traditional mutual funds is to visit our website for some free research reports to get you started.
Every investment has risks. The important thing is to minimize them. You cannot evaluate the merits of an investment until you have a thorough understanding of both its potential risk and return.